Samantha and Jessica and Juan and Atika. So I'll go ahead and introduce you. So I'm excited to have you here. This is Robert Graham. He is our tax accountant for Graystone Investment Group. So he helps us with everything from making the 1099s every year, getting you paid. So he is one that you definitely want to be friends with. But also he's going to help you out with all your investors with handling the 1031 exchange and any questions that you have with taxes. So this is Robert Graham, and I'll share the email with you below as well, and also in your in the WhatsApp chat. So without ado, here is Robert Graham.
Hey folks, how are y'all today? Hope everybody's doing well. I know you'll have a bunch of questions about this, so I'll let Nadia start off and she can just start asking away. And if you want me to frame it in any particular way, just let me know.
Yeah, perfect. One of the biggest questions that we have is, I know there's so many different tax laws out there right now, but what currently has changed this year, and what have you seen different with the real estate tax bracket, basically? Anything in the real estate, have you seen anything change this year that would affect the agents in selling?
It really goes back to the beginning of last year, and the single biggest thing, it's not really on the agents per se, it's on investors in real property, and that's the 20% qualified business income deduction. If you're familiar with it, just to cut through the crap, what it basically means is if you have real property, then the net income from it gets a 20% tax deduction that comes off the top. And there's a phase out in income levels, but as a general rule of thumb, that lowers the overall tax rate on rental income. So that's a good thing. There are some more liberalized deduction rules with respect to the types of property you place in services like air conditioners or roofs or whatever, more accelerated depreciation methods. But those go through for the investors. With respect to the real estate agents themselves, the only big thing that changed was in 2018, and that had to do with entertainment expenses. And entertainment's like, taking people to the hockey game or the football games or something like that. The cost of meals is still a deduction, but entertainment, where sports or recreation or music or any of those venues are played, are no longer deductible until 2025, when the rules are set to phase back out. It's called a sunset provision in the law. Other than that, the single biggest thing will be the changes in the amount of the standard auto deduction. That changes depending upon how the IRS sets it based upon oil prices. It went down last year. The way oil prices are going now, it's going to go back up. I look for IRS to make an adjustment towards the latter part of the year. Now, we do not know what the Biden administration is going to do, so we're all still kind of sitting on pins and needles waiting to see what happens there. I don't anticipate anything with respect to any self-employed individual right now. I don't see that happening. And most real estate agents are not W-2 people. So.
Okay, and so yeah, that's some really good information on the 1099 employees. Is there anything that changed at all with the with respect to the real estate, like as flipping or for investors for their clients?
Well, one thing you need to be aware of, there's a difference between people who are investors. Investors mean that the intent is to hold the property for the long term. That is, you buy it to either hold it for asset appreciation, or you buy it to hold it for rents. If you're buying a piece of property with the sole intent, and it all turns on intent, to take that property, put some improvements in it, and sell it, it is no longer investment property. It is property held as inventory. It produces two types of income. It produces ordinary income. You don't get any capital gain, not short term, not long term. It's all ordinary income or ordinary loss. But if it's ordinary income and somebody's self-employed, it also produces self-employment tax. Self-employment tax is to the extent that you're not over the Social Security threshold, which is approximately $150,000, is an additional 14.144% on top of the regular income tax. So you could run your tax rate up really quick if you're not prepared for it. Now, you make good money off of flipping property, but you got to be prepared for the tax impact. A lot of people incorrectly try to take them as short-term capital gains. That's not correct. IRS will adjust it upon audit, and they are really pushing audits of flipped property. There is a presumptive rule: if you sell 1, 2, or 3 in a year, that you are now a dealer. So you better be prepared for that tax consequence. There is something else with respect to the real estate property. In addition to that, I don't know whether you guys are familiar, there's something called the passive activity loss rules. Those basically say that the losses from passive activities, which are real estate, rental real estate, is by definition a passive activity. There's a limitation on the amount of passive losses you can take in a year. There's an income limitation. It phases out after total income other than that exceeds $150,000. It starts phasing out so that there's no deduction after it for high income taxpayers. But in addition, it's capped at $25,000 per year. But there's something else that goes over and above that. There's something called the excess business loss deduction. If you're in a business that produces, for instance, the real estate business, losses in excess of an applicable threshold, which is $250,000 on an individual and $500 on a joint return, those excess losses are capped. You take them forward as capital loss carryover. So you can't produce a huge loss and be able to deduct it against other income during the year. But that applies after the passive activity loss rules. Those are the real big changes to real estate.
Wow. Okay. No, that's really interesting. And so, if you are looking to flip, how many years do you have to hold? Does it change like after 2 years? I'm going to throw this in there real quick.
It turns on intent. It really turns on intent. If you've got somebody that's buying property to hold and rent out and property to, turn and flip, I always recommend that they set them up in different LLCs or different companies and not do it individually. That way you don't taint the long-term holds. So but really do it with intent. And the best thing that you can do is document it in writing when you buy something. Doesn't mean something's going to come down the street. You could buy something with the intent to hold it and rent it and, beach property, and then somebody moved down from New York and offer you way more than what it's worth and you sell it. That doesn't make it a flip property, but it all turns on what your original intention is when you bought it. If you put a bunch of improvements in it, the IRS is going to be by definition looking at it as a flip property.
Oh, yes, that makes sense. Okay, so they're looking at it as you've built this up to flip it, even if you are going to rent it for a year or two. It's still
if you hold it and you're renting it out for more than a year, you're probably going to have more feathers in your cap to say that it's long-term hold. But if you do it and you only rent it Airbnb for 3 months or 4 months and then you sell it, probably not going to work for you. You're going to probably lose that argument.
That makes sense. That makes sense. Okay, one other thing that is huge right now, basically the elephant in the room, is a 1031 exchange, because we are having so many investors interested in flipping right now. And like we discussed earlier, mainly it's because of the increase in prices right now. So they are looking at doing it. Could you explain a little more about what the 1031 exchange is to the agents and how we can use that?
Well, a 1031 exchange, really, you only want to worry about it when you've got property that's got a lot of built-in gain in it, obviously. You certainly want to take your losses if you can take your losses. But a 1031 exchange is a like-kind exchange. It is investment or rental property for investment or rental property. It has to be like in kind in terms of use or service. Now, that doesn't mean you can't do raw land for rental property and rental property for raw land. You can still do that. It just means that those are the qualifications. They want it to be real property for real property. Personal property doesn't qualify. And any entity can do it, whether it's an LLC, a corporation, an S corporation, a trust. Any of those entities can do a like-kind exchange. The only restrictions are when you're dealing with related parties. If I want to do a like-kind exchange with a partnership in which I'm a 50% or greater partner in, or with family members, there's a holding period requirement. That means that both of us, once we do the like-kind exchange, have to hold the property that was exchanged or exchanged for a 2-year period. If we blow that 2-year period, then we have to go back and pay tax on that gain plus penalties and interest. So that's a problem. You don't want to do that.
Okay, so you do need to hold that property for 2
That's
years.
only with related parties. Only with related parties. With respect to a 1031 exchange, the facts and circumstances can dictate that you sell that property within 12 months or 24 months or whatever. But realistically, anybody that does a 1031 exchange is trying to get out of a higher tax bracket year and hopefully position it into a lower tax bracket year, or match it with losses in an upcoming year.
Okay, and we have a lot of people right now where their property has gone up so much that they're looking at selling it, say, for $500,000 or $1 million, and then they want to buy 2 properties.
Absolutely.
That's something you can do as long as it's like to like, correct?
As long as it's like to like. And let's talk about that for an instance. You can trade a commercial building that's now worth $1 million for 10 residential properties worth $1 million. The only thing you have to worry about is whether or not there's boot on the tail end, and I'll talk about that in a second. But it doesn't matter, as long as the aggregate value doesn't exceed 200% of the relinquished property, you're in good shape. And that's for the identification. Remember, you still have 45 days to identify the property that you wish to, and you can do 2 things. You can identify a specific property within that 45-day period, or you can target 3 properties and say, one of these 3 properties, okay, as long as the fair market value doesn't exceed a certain threshold, but you have to close on one of those 3 properties within that 180 days. One of those 3 properties has to be the subject property. So that gives your investors a little bit of flexibility. They can say, we're trying to buy property A, B, or C. As long as those 3 properties qualify. And remember, with a like-kind exchange, what you're looking for is to trade equal or up. If you trade down, you can cause some problems. When you trade down, if there's a reduction in your overall liability, or if you receive cash, or if you receive other properties that's not like-kind property, like personal property, unless it's, they call it incidental, which is less than 15% of the value of the property that you receive in the transaction, the like-kind property. If you receive any of those things, it's called boot. Boot produces tax. So if you trade a $500,000 home for a $400,000 home plus $100,000 cash, you're going to pay tax on the the lesser of the gain you would have realized or had you have sold it, or the $100,000 that you received. So
That makes sense. So really, if they were to do that, they're better off looking for a $100,000 investment property, right?
You're better off looking for something equal to or greater than. You always want to go equal to or greater than in order to defer that gain. And you want to make sure that your liabilities don't substantially reduce. If your liability is substantially reduced, the IRS considers that as if you got cash and paid that liability, that debt. So you can't kind of cash out on the equity, that side of it. It doesn't mean you can't refinance after you've done the exchange and then cash out. It just means at the time of the exchange. There's 2 types of exchange. There is a deferred exchange and a direct exchange. Direct exchange are very difficult. That's where I say, Nadia, you have a house, I have a house, let's trade. That's a direct exchange. A deferred exchange is when you find a qualified intermediary and you say, hey, I'm going to sell this house. You're going to hold the money for me. I'm going to park the money with you. And then I'm going to identify a property. That's who you send the identification to, and you identify it in writing within the 45-day period. And they hold the money, and they are a party to the transaction that purchased it. And, not anybody can be a qualified intermediary. If you had a financial association with that person within the 2-year period prior to the transfer of it, they cannot be a qualified intermediary. So your attorney, your CPA, your real estate agent, your real estate broker, they're not going to be able to be a qualified intermediary. There are a lot of companies out there, I'm sure you've run into them, and a lot of title companies now are doing that type of work.
Yeah, that's really interesting. I didn't know that was even an option. So that's.
There is also something called a reverse exchange. A reverse exchange is where you go, hey, I'm going to sell my property, but I found another piece of property I like. I'm going to, you find somebody else, they're called a transfer agent. What you do is you take them, they buy the property essentially ahead of time for you, and then you do your transfer with your property through a 3/4 exchange with them. So it's, you sell it, the money goes to them, they transfer the property to you. So that allows some investors, particularly large corporations, to do a build to suit, because they'll find somebody to do that, and then the property may not exactly be to their specification. So that person actually contracts to have the property improved within the specified 180-day period to close. And then at close, they get something substantially equal to what they're trading. So.
Gotcha. No, that's extremely helpful, especially when it comes to these investors, to know what their options are and how to handle them.
Now, you know, with the types of property that can be traded, you can't do a personal residence. Now, it doesn't preclude you, if you trade it, done a like-kind exchange at some point in the future, you can flip that house to a personal use, but there has to be an intent to hold it out. And what most of the scholars recommend is a 24-month or greater period. So if you trade out of a rental house to another rental house and your intention is supposedly to hold that as a rental, it doesn't preclude you from eventually moving into it and using it as a personal residence. You just got to be careful and make sure that you document that that wasn't your intent on the first part.
Okay, so say you're saying that if you were to be doing the 1031 exchange on an investment property, but you go ahead and rent it out for a certain period of time, your intent's to do that, but then you decide to live in it, you still can capture that 1031?
You still get the 1031 exchange. Now, in order to get that $250,000 to $500,000, permanent exclusion from your income tax when you sell that, you're still going to have to wait that 2 out of 5 year period afterwards. So you can't just hide and avoid the taxes forever. So
Gotcha.
you understand what Congress is trying to do. They're trying to be fair. So if you're somebody that lives in, I don't know, Florida, and you buy a rental house in San Diego, California, and then after a couple of years of renting it out, you decide, hey, I want to move to San Diego. I really like it. It doesn't preclude you from moving into that house.
Understood. Yeah, because they're not wanting to hurt you. It's just that they're trying to make it so that you're not making a ton of money off the capital.
Correct. Now, you can't do your personal house and do it. You wouldn't want to your personal house because you get the $250,000 to $500,000 gain. But personal property is excluded from 1031 exchange. Personal property, inventory, any of those things.
Okay, so say we actually have one right now that they're looking at selling their home. They have it; it's their personal home for $1 million, but they're looking to downsize to $500,000. If they bought a home, they bought their regular home $500,000. Are they going to pay that capital gains on that?
Yeah, they can't do their personal house or rental house. They can do a rental house and for a rental house, and then eventually turn that second rental house into a personal residence, but you can't do a personal residence for a rental property. They're not like kind. Remember, like kind. Also, one quick rule, since you've got a lot of foreign investors, foreign property and U.S. property is not like property. So you can't do foreign property for U.S. property or U.S. property for foreign property.
That is actually really important. Thank you for throwing that in. That is actually huge. Does anybody have any questions? I see Norma, a few of you guys. Is there anybody that has any questions? Jorge's on here as well. Please jump in if there's anything that you'd like to ask Robert, because he's extremely busy, I know, and this is your one chance to definitely get a chance to ask him any questions. I think Jorge's there somewhere, so we'll see. But okay. So one other question. I know that it's things have been changing a little bit in the market, but you're saying that not much has changed with the taxes as of 2021. Do you see anything changing for when the Biden administration comes in? Changing?
The thought process right now is that there's going to be some significant changes in the upper tier tax rates. The target right now seems to be that $400,000 plus range. We're not sure how that's going to translate to individuals, whether it's going to be 400 and then divided into the 200 and 200, or whether it's going to be 400 and then 800. The plans are still in flux, and they're getting, you know how the government works. One side screams, the other side yells, and then hopefully they come together at some phase. But we will definitely, before the end of September, see a major push for tax law change. I think one of the things that's scaring people right now is there has been a really heavy increase in prices, and I think they're a little worried about inflation right now, and they're afraid to rock the boat and hit us into a stagnant economy. That's more political than it is tax. So.
That makes sense. Okay, do you see anything changing possibly with the 1031 or anything like that?
I seriously doubt it. The one thing that I'm concerned about is the interest deduction on a second home. I think that may be on the chopping block. There's been some discussion in some of the publications that I've read that some of the members in Congress are willing to sacrifice that as an itemized deduction. So I think you guys know that individual itemized deductions for state taxes was capped at $10,000 a couple of years ago. So that really took out a big chunk off of some people with really high net worth that had really big homes. They lost a big chunk of their itemized deductions for it.
Yeah, that definitely made a big change. Absolutely. So, what do you think? Is there any big changes that you'll see for foreign investors or regular investors the next few years?
You know, the difference with the foreign and the regular investors, I don't see a whole lot happening right now, although I see them tightening up on some of the foreign investment players' rules. There has been a big push in Congress to make sure that or not in Congress, really by the IRS, to make sure that any of the foreign investors are actually treating the income and expenses correctly. The FERPTA rules with respect to real estate are very tight, and they are not often always rigidly followed. So, and if you're familiar with FERPTA, you know that FERPTA requires a withholding on the sale of property owned by a non-resident alien. And that includes a conduit entity in which the non-resident alien is the sole member. If it's a partnership, there's some different rules. But if an LLC is owned by someone that is a non-resident alien, then that person is deemed to be the owner for purposes of the FERPTA withholding. And there's a 15% withholding at the time of sale to the sales price. It's really important if you've got a foreign investor that wants to outright sell their property, that the minute you find out they do, you want to start the process of getting a tax reduction certificate in if it's getting, if it's early in the year or the first of the year. Obviously, if you're close to the end of the year, you can, file the return quickly and get the refund. But it takes IRS 60 to 90 days to process those. So they try to be quick, and unfortunately, in the last month, they've actually started catching up. But it was running 90 days at the end of last year. You're back on mute again.
Oh,
Ronnie.
there we go. Yep. Yeah, I know we had that issue with one of our recent investors, and they were wanting to sell in the beginning of the year, and that we had to push for it.
Yeah, the problem though is this, that, they'll get the withholding. They do get it back. They just have to, understand that they're going to get it back if they file their tax return. But if you can do some proactive planning on it, and if you've got enough information, send off for that thing as soon as you can.
Yep, that makes really good sense. And what we do here with Graystone too is that we go ahead and once we have that foreign investor, we partner you guys on a WhatsApp so that we can get this process started. So Robert is here for us with our foreign investors to get that started. I do have a question here. Louisa is asking, what is the best way for a foreign client that wants to buy an investment property here in Florida to avoid paying taxes here in another country?
To avoid paying taxes here and in another country?
And in another country.
Well, there's no way to avoid taxes in the United States. You have to pay your fair share. Most of the countries have tax treaties, and under the tax treaties, and there's a whole list of countries that do, they're very easy to find, that have tax treaties will have something built into it to take a credit against the foreign taxes for taxes they paid on the same income in the US. Most of them have that provision. Now, there are some countries that we do not. For instance, in South America, we don't, there's a rather large number of countries in South America, Colombia being one of the largest, that we do not have a tax treaty with. We don't have a tax treaty with Venezuela. We do with Mexico, but Ecuador, we don't have a tax treaty with. So you got to be careful and look and see. And I do not know the laws of all the different countries, so I don't know what they have built into their tax provision. But many countries do have provisions in their tax law to provide for the elimination of double taxation.
Okay, yep. And I think what she was.
I'm sorry.
Go ahead, Louisa. There you go.
Nadi, I'm sorry. My question was about paying taxes in both countries at the same time, because I have that investor right now, and she asked me if it would be better to create an LLC here in Florida, so they can, buy through the company, and then they can avoid paying taxes in Colombia as well. So they just pay taxes for that property here only.
Well, I don't know what the Colombian tax law says, but if you have someone that forms an LLC is either treated as A, disregarded if there's only one owner, or a partnership if there's multiple members. Now, the LLC for a single owner, that single owner is going to get a U.S. tax identification number. And in order to avail themselves of all the deductions, they have to file a form called W-8 Effectively Connected Income Statement. It's a statement that says we're going to treat this property as if it's a trader business. If they fail to do that, they're going to have to pay tax that you, as whoever the property manager is going to have to withhold 30% of the rents. That's by law. That makes it very inappropriate to hold real property. If you make the effectively connected income election, that means you treat all of the income as if it were a trader business. You get to deduct depreciation, repairs, maintenance, all of the expenses, and you can reduce your U.S. income tax, but you do have to file a U.S. income tax return on it. You get to avail yourself of the lower income tax bracket, including the capital gains tax, but you still have to do it. If it's an LLC that's multiple members, there are some different rules. Partnerships are required. So an LLC, the LLC itself, if there are multiple members, would be required to withhold and remit tax to the IRS based upon whatever the net income from that rental property is. Now, normally rental property in the first 1 or 2 years spins off losses for tax purposes. So as long as it's doing that effectively connected income, it's going to spin losses off. It's when it sells the property that the problem is going to result. That partnership will be the one that files a withholding statement withholds the tax from the proceeds and remits it over to the IRS. Whereas with a sole member LLC, it will be whoever sells or purchases the property. A single member LLC or an individual, whoever the buyer is the responsible person for withholding taxes on the sale of from a non-resident alien to someone else in the US. So
Thank you very much.
Yeah, perfect. And I do have two other questions actually that are coming up. Juan's asking, as a realtor, what is the best way to structure our entity to pay the least amount of tax as a real estate agent, I believe, right, Juan? And I'll go ahead and let you answer that, Rob.
are you talking about if you're a real estate agent, how you want to set yourself up?
Yeah, should we set ourselves up as an entity, personal, LLC?
I always like LLCs. You know, there's two things at play. First of all, as a real estate agent, state law requires that commissions paid to an agent have to, or a company owned by that agent has to be in the name of whoever the licensed agent is. So you can't set up, you know, Property Extreme as a company and get an agent commission. It would have to be Nadia Daggett LLC or Nadia Daggett PLC, which is a professional limited liability company, or Nadia Daggett Inc. It would have to be an entity with your name on it. But second, in order to save the most taxes, the best thing that you can do, particularly, I look at a $60,000 net income range for me, because that mitigates the cost of everything else. If you expect that your net income is going to be greater than 60,000, I recommend that you set up an LLC or an S corporation. If you do the LLC, you make the election to be treated as an S corporation, and then you put yourself on payroll. It means you have to do payroll tax returns or hire a payroll tax service to do payroll tax returns for you. You have to make monthly deposits to it and pay your taxes, but it does give you the ability to leverage some of the profits off in terms of dividends and save that Social Security and Medicare tax. So if you're pulling down $250,000 worth of net income, and you can limit the amount of salary you're taking to say 150,000, once you pass that Social Security threshold, you're looking at about 3% on top of that. But think of it this way: you can save up to a maximum of about 15% on it. So it's a smart play to do it. Now, IRS says that you must pay yourself a reasonable salary that's commensurate based upon the business, but that doesn't mean that you can't, you know, be a little aggressive as long as you're not greedy.
And if you're doing
You can't
that,
make $150,000, take 120 as dividends, and pay yourself a $30,000 salary. That's going to be a problem for you. But you can take 100,000 and take 50 in distributions, and that may not be such of a problem.
that makes a lot of sense. That's good. And then if you were to file an S corp, is there a time period that you need to file it? Like say you
S election has to be filed within 90 days of the formation of the entity.
Yeah, I know that's come up before in my
You can do it within a year end for the next year, just as long as it's 90 days before that election comes into effect. So if you form it on January 1st, you have till March 15th. And any other time during the year that you form it, you do that 90-year projection. Doesn't mean if you've blown it this year, you can go back next year and file it for the next year. And oftentimes, depending upon the facts and circumstances, you may be eligible for late filing election relief. IRS is pretty permissible. Like during COVID last year, COVID, made you miss the deadline, you could have asked for a COVID relief exception. Or if you did the election and you gave it to, your attorney or the person that helped you form it, and they failed to mail the election, that could be a potential excuse. Or if you were sick and unable to make the election, if some kind of extraordinary event happened that caused you to miss the election, you may be able to make a late election. There are some rules for it and some specific language you have to put in the election to ask for the late relief. But it's about 90% of the time if you've got a good excuse. within what they call a good excuse, that you can have that election recognized.
Okay, so if we were to do the S Corp as an agent, then we just need to make sure that within 90 days we make that election.
Absolutely. I would recommend if that's your intent, you do it the minute you get the tax identification number for it.
Gotcha. Okay, I have one
Do it all
other.
at once and put it out of the way.
Perfect. And I have another question. This one's from Jorge. He says, what are the biggest mistakes or missing opportunities agents make when filing taxes?
Missing deductions. The smartest thing that you can do as a real estate agent is open a separate business account and isolate all of your business transactions to it and monitor your automobile miles. Regardless of whether you use actual expenses or whether you use mileage, you're required to track your business miles. I've been through probably in my life 35 to 40 IRS audits, some of which I've taken to appeals. And I can tell you, in the last 5 years, since a lot of agents and a lot of other people have used applications like Mile IQ, when they have those applications and are able to come in with that printout, it is a written contemporaneous record. IRS loves it. And I have never had not one person that produced those documents have their mileage questioned, not one. Now, I've had so many that took that mileage log, that old analog log, and I've had IRS ask for documents proving what the mileage was at the beginning of the year and what was at the end of the year, and they calculate their averages and they look at it to see. But those applications are lifesavers for you. The other thing that is really important and is targeted by IRS specifically with real estate agents are meals and entertainment, closing gifts, and travel. If you travel, you better have a really good reason to have travel. If you go to Miami, you better have made some Miami sales so that you can document that you were down there soliciting business. If you have meals and entertainment, you better document someplace, either on the receipt or in some sort of log someplace, who you met with, what business you discussed. IRS requires you to document the who, what, when, where, and how.
Gotcha. That makes a lot of sense. So I wanted to just ask anybody if you guys have any questions. I know we're getting into about 5:40 now. I just wanted to see if anybody had any big questions for me. You can post it in the chat or you can ask Rob now, because I know this is a huge opportunity. Most agencies, we don't have the opportunity to have a tax accountant here with us and at our fingertips. So we really thank you, Robert, for being here to answer any questions that we have. Is there anybody that has any questions? I think I was hearing someone. Is that Luz?
Yeah, I had a questions. If somebody and if personally they have the 3 condos, they can deduct all the expenses from her income, or they need to be in one LLC for reduce all expenses, or what is the advantage they have the LLC for put 3 condos, or what is the advance in reference to file taxes directly? What is the difference between 2? You understand me?
Between as an individual or an LLC?
Yes, an individual and have the LLC for all the deduction, because I have somebody that they say, no, I deduct all the expenses, but they file the taxes in his name or her name. And what is the difference? What is the advance between? I know that you have the LLC, you have for something, security or something like that, you know, for liabilities or that, but I don't know si they can deduct all the expenses, looks like the one person.
You know, the real truth to deducting business expenses is the real rule is it has to be a ordinary, necessary, and reasonable expense. Ordinary means that anybody else in your business would have it, like super dues, or signs and posts, or advertising or closing gifts. And you know, with closing gifts, you're limited to $25 per giftee. So you can only give somebody something worth $25. So I always recommend go get a bunch of Home Depot $25 gift certificates, and you can use your own judgment as to how you dole those out, but that at least shows that you're doing 25. There is no difference between what one entity versus another entity can deduct. That would be a violation of the US Constitution's Equal Protection Clause. The primary difference with an LLC, particularly if you use it and have a separate bank account for it, is that it shows that it is specifically a business, and it does provide you some indemnification against the claims of general creditors. That's more illegal than a tax thing.
No, that's really good information. Luz, did he answer your question there?
Thank you for the information. I think, yeah, it's more legal than taxable.
It's
That's
more
the
legal
thing.
than tax. But again, a lot of people that do that, set up an LLC, eventually make that election to treat it as an S corporation so that they can leverage some of the profits off as dividends and insulate it from the Social Security and Medicare tax.
Perfect. Perfect. And thank you so much, Robert. And when it comes to doing these, having questions with our investors or with the way that we're going to be setting up our own entities, are we able to reach out to you, Robert?
Just shoot me an email over or a text message. Emails stick longer than text messages, so I'm more apt to answer you quickly with an email. But if you text message me, that's fine.
That's great. Yeah, because Robert was asking, Juan was asking if he can call you to discuss. So yeah, Juan, if you can email him, I'm going to go ahead and post in the WhatsApp group your information, and also underneath and in this chat, I'm going to add your email and phone number that they can reach out to you. And also, if you need somebody to do your taxes too, I'm hoping that you would definitely be willing to do that for the agents as we move forward.
And I've kind of prepared little bullet points of the 1031 exchange. I'm going to clean it up here, and I'll shoot it over to Nadia, and she can disseminate it to you. It kind of goes through everything just in little nuggets so that you don't have to read a lot. But it should contain pretty much everything. It's not comprehensive. Nothing is, but it's pretty precise.
That's perfect, because that's what a lot of our investors are asking is 1031 exchange, and we are having a huge amount of investors coming in requesting this because, like you said, the profits are such high amounts this year. They're trying to get that 1031 exchange marked off.
I remember when it crashed back in, what was it, 2005 or 7, that all the 1031 companies went away for a while because everybody had built-in losses.
Yeah. Yeah, exactly. So we're going through something similar, not exactly the same, but I see that a lot of that, and a lot of our investors are asking questions, and especially like you said, the foreign investors, and that we need to be able to process this quickly for them, especially at the beginning of the year. So thank you so much, Robert, for jumping in here and answering the questions. And is there anything you'd like to share with the agents at all? Anything that, if you can tell them your contact information and anything else you may have?
Well, I'll let you disseminate that. The one thing that your agents should remember is that, given, I'm familiar with your setup over there. So probably all of them are going to qualify for a home office deduction, because I can almost guarantee most of them do most of their work out of their home office. So they need to look and familiarize themselves with the rules for home office deduction, which basically means you have to have an area in your house that you use regularly and continuously and exclusively as the place that you either maintain your records or maintain contact with your customers and clients. And there's a whole plethora of things that you can deduct with it, and you can take a proportionate share of your house. But I'm pretty aggressive myself about internet, because I have an internet at home, and I can assure you that I spend probably a good 8 hours a day receiving and sending and transmitting information on it. And I do deduct 100% of my internet as a result of it, and I will go to appeals with that one. It's too small of a deduction for IRS to scream about.
Yeah, that absolutely makes sense. And I know a lot
Every
of
penny that you can save is a penny that you put in your pocket, so.
Yeah, no, really good information. Thank you so much, Robert. And I'm going to go ahead and put your information below. And I'm also saving this video so that we can look back and if we want to reflect on any of the 1031 exchange. And you said if you email that to me, I'll also give that to all the agents, any tidbits on the 1031 exchange and any information that you have to share.
Good, good. Hopefully it'll help them and help you guys make more money and more logical decisions with your investors.
Yep. And one thing that we want to make sure that we always offer our agents is the ability to have that network. So we have Robert here. He's at your fingertips. Please do not hesitate to ask him any questions and ask him anything that you may have as an agent or for your investors, so we can do the best by our clients as well. So thank you so much, Robert. And let me know if you guys have any questions and we can put it in the WhatsApp.
Perfect.
All righty. Have a good day, guys.
Thank you. Thank
Take
you.
care now.
Thank you, guys. Have a nice night.
Good night.
You too. Thank you.